Welcome to The Explainer. Let's just dive right into the real story behind the economic landscape of August 2026. Right now, the surface of the financial world looks like a glassy, perfectly still lake. But as we're going to see today through some incredibly revealing data, there is a massive, complex current moving right beneath us.
Take the VIX, for example. Right now, our favorite fear gauge is sitting at a historically low 14.25. To put that into perspective, that is the lowest point we've seen since December. The historical average usually hovers way up around 19.45, and we've actually only been below 15 for about a third of the trading days since 1990. We're in our third straight positive week for the S&P 500, pushing past 7,780 points. So on paper, everything feels, well, safe. But you gotta ask yourself, are we actually in some golden era of market stability? Or are we just experiencing something else entirely? Like, maybe we're just seeing headline fatigue, where investors are simply ignoring the massive risks out there. Because honestly, even with an unexpected drop in retail sales and rising crude oil futures recently, the tape just didn't move. It's like the market is happily pricing in benign inflation, scaling back bets on rate hikes, and basically just putting on noise-canceling headphones to the rest of the world. And that brings us to the core illusion we're navigating today. It's a perfectly calm surface masking massive structural and geopolitical churn just beneath the waterline. It's our job today to map out exactly what those submerged hazards are. Take what I like to call the earnings paradox. We just saw a spectacular 31% Q2 S&P 500 earnings growth. Excluding paper gains, that is the strongest first-half tally since 2021. Yet the projected market upside to the year-end 7,900-point target is a remarkably low 1.5%. Why? Well, Wall Street is already pricing in perfection. Those impressive gains are entirely booked. The good news is essentially already spent.
Section 1. Unseen Tech Blind Spots. So the biggest players in the world have some extremely heavy bills coming due that just aren't sitting plainly on their balance sheets. Beneath the surface of disclosed capital expenditures lies a colossal $3 trillion blind spot in off-balance sheet commitments for data center leases and AI chips. We're talking about massive exposure here for giants like Alphabet, Meta, Oracle, and Amazon. As we close in on the fourth year of this AI-led rally, projected earnings growth for 2027 is actually expected to slow down to 13.6%. But those massive hidden liabilities for industrial equipment and data centers, those remain entirely real. Pivoting over to the private markets, SpaceX is another behemoth lurking just under the radar. Their cap table is incredibly concentrated. Sure, Elon Musk holds 48.4%, but other major players are holding huge slices too. Alphabet is sitting on 551 million shares. Fidelity and BlackRock are mixed into the 455 million institutional shares. Even NVIDIA holds a strategic 123 million share slice. This kind of heavy concentration among tech giants and institutions is basically a coiled spring. And here is the ticking clock on that spring, the lockup expiry. A massive wave of 4.2 billion SpaceX shares is set to unlock by year-end, creating this immense downward pricing pressure that the broader market just isn't fully tracking it. To make matters even more urgent, 319 million of those shares unlocked this very week. That is a massive influx of liquidity and potential selling pressure from some of the biggest institutional names in the game. Moving to Section 2, the consumer divide. The everyday American consumer is incredibly divided right now. Big-ticket home improvement is seriously struggling against 6+% mortgages and stagnant existing home sales. Meanwhile, daily essentials are stable, getting a nice little boost from lower gas prices, currently hovering around $4.06 a gallon. But the real surprise? Accessible luxury is surging. Brands like Ralph Lauren and Coach are absolutely winning right now because people are abandoning massive kitchen renovations to buy, say, $12 designer tennis socks. It's highly strategic. People are trading huge, expensive projects for affordable, accessible hits of dopamine. It's a really stark contrast. We have this home improvement hangover born from the end of the 2020 remote work era, plus an AI boom that's soaking up investment and creating more expensive materials. Yet, at the exact same time, Hollywood is boasting a $10 billion summer box office. Summer-specific box office growth is up 23.6%, fueled entirely by robust middle-class discretionary spending. So the money exists, it's just flowing into entertainment instead of renovations.
Section 3, Hidden Geopolitical Threats.
First up, we've got a brand new trade playbook to watch. Starting September 3rd, highly targeted tariffs on items like drones originating from China are going to hit hard, facing massive 25% to 100% levies. This triggers a super strict system of compliance checks. Any evasion attempt, like trying to transship through the EU or Japan to access lower rates, will be completely blocked under heavy scrutiny. Only the strict compliance route, using major U.S. source components, secures the preferential 15% rate. This highly targeted sectoral approach is going to drastically impact global supply chains.
Now, on the geopolitical radar, the 60-day Iran ceasefire actually expires this coming Monday. While markets have largely priced in a diplomatic exit based on memorandums of understanding to reopen the Strait of Hormuz, the data indicates that hardline leaders view the talks as a delay tactic. Tehran has utilized this 60-day window to rebuild missile infrastructure, yet the market remains entirely unpriced for any kind of immediate escalation. Section 4. Balancing the Scales. So, looking at the week ahead, Monday kicks off with that geopolitical Iran ceasefire expiry. Tuesday brings Home Depot earnings, which will really test that struggling home improvement thesis we just talked about. But Wednesday represents a massive convergence point. Macroeconomic data from the FOMC, vital retail earnings from Lowe's and Target, and looming trade deadlines for U.S. tariffs on Canadian goods, they all crash into each other simultaneously. It's basically a traffic jam of major market catalysts. Ultimately, it all comes down to balancing these scales. You've got the zen calm of low volatility, the 31% earnings growth, and a booming summer box office. But weighing heavily against all of that is the $3 trillion hidden AI capex, the $4.2 billion SpaceX share unlock, housing market stagnation, and serious geopolitical escalation risks. You can absolutely enjoy the market's zen state right now, for sure, but you must actively prepare your portfolio for the hidden volatility that is bubbling up from the bottom. I'll leave you with this vital thought to consider as we close out today's explainer. Look at your own strategy. Is your portfolio currently priced for perfection, assuming this glassy lake stays perfectly calm forever, or is it truly prepared for the deep churn we just uncovered? Thanks for joining me, and keep questioning what's beneath the surface.